over the long term, the market goes up for two reasons. Number one, population growth, and number two, productivity. And as far as the shorter term goes, over the past 3 years, there have been nine corrections. The average has been a 14% decline for the NASDAQ. And lo and behold, the current sell off has gone down 14% and stopped.
And everyone's hair is on fire, as it usually
Everyone's
is.
saying, oh my gosh, what a
Yeah,
disaster.
exactly.
Is this it? Is it finally over? No, it's not finally over. Nor was it finally over. Each of those other nine declines that proved wonderful buying opportunities for thoughtful long-term investors. And I think that is where we position ourselves for success.
Yeah. No, it's a good point. I mean, if you look at the market historically, it goes down about 30% of the time. So being bearish, if you're a gambling person, or gambling man or woman, which I'm not, like, they're bad odds. Yet,
Well, yes,
yeah,
what you're saying
yeah.
is the market falls one day out of three, which means by definition, the other 2 days it goes up. I'd rather be long if 2 days out of three it's going to be up. Yes, there are downdrafts. There always are. In the same way that partners have disagreement, whether they're work partners or marital partners, but they figure it out and they work through it.
Yeah, but then like people forget too, like what market's down. Not every markets are down at the same time. I mean, look at this year. International's up big.
Yeah.
Not everything gets affected.
Yeah, no, it's a good point. And I think the bottom line too is when you talk about Wall Street in general, it just seems like it's a negative bunch. Like everybody wants to be that guru who calls the top. And I think you almost sound smarter when you're negative or you're more pessimistic. And I think that's our problem, Adam. It's like we're always coming out there. We have all this optimistic view of everything, but the odds are that's probably correct. And I think sometimes people think, well, that can't be as smart. And we won't name names, but some people come on there all the time. They've been bearish for like 20 years. They've never been right. But every time it's like, they know something we don't know. And that drives me crazy.
Yeah, there's an irony. Bears always sound smarter than bulls.
Yes.
They're skeptical and they see something that happy optimists just don't see because those happy optimists are wearing rose-colored glasses. Actually, no, we're not. We're just finding wonderful ways to build our wealth over time.
Well, I think Bob is the ultimate optimist.
Well, it's because I always read Alan Abelson in Barron's. Do you remember him?
Oh, yeah. He was great.
I don't think he ever said to invest, ever. There's
Right.
always reasons why you should be selling.
Yeah, I know.
But I mean,
know.
it is common sense, right? Over time, you look at when I started in the industry, we had 4 billion people on this planet. Now we are closing in on or over 8 billion people. And you have the internet. So, you have somebody living in an emerging market who takes a look on the internet to see how the average American lives and says, you know what? I want that.
Yeah.
Why wouldn't I? Right. And how hard is it if you run a company, we suddenly have 8 billion customers where you only had 4 billion customers before? I mean, it's almost like, you accidentally make more money. So, I mean, it's such common sense, but again, it's the emotions of people that make it so difficult for people to stay invested because even Chris and I spoke the other day, went through all the positive reasons why you should stay invested right now. And the client said, yeah, but Chris, you don't understand. It's different this time.
As a matter of fact, we were talking to a friend of yours down in Naples, and he owns a business. He's in manufacturing, and he was talking about how they're going to get around these tariffs, how they're going to be able to increase their profit margins and change the way they do business. So like all the CEOs around the world,
They're figuring it out.
yeah, they're not like, okay, you know what, let's shut the doors. What do we got to
Right.
do to be profitable?
Oh, gosh, they're tariffs. I guess we're out of business.
Yeah.
No, we'll just find a way around them. We're not sure how yet. We're not sure how much of the tariff we can pass on to our customers, but we'll probably pass some of it on. We'll probably eat some of it. So where can we cut costs elsewhere? Oh, wow, look at that. We found ways to cut costs. So we preserve our margins, right? I mean, that's called creativity. Well, that's American ingenuity.
Well, hey, China did the same thing, right? We put all these tariffs on China. Well, guess what? All of a sudden, all of their stuff's going to Mexico. It's going to Vietnam, and we're still importing here to the U.S. So, yeah, right, it's a game to play. Everybody's playing the game. And I think that's the problem right now is we just don't know what the tariffs are. If there's going to be tariffs, fine, but just give people certainty that they can make decisions, which hence that uncertainty causes volatility, causes the sell-off, which hence this is the time when you want to pick up shares at a lower price. So it's kind of like use that uncertainty as your friend as opposed to let's wait and see. Because once we know, typically markets are off to the races.
Well, and I also think that we need to recognize tariffs are not necessarily a means unto themselves, but they are a bargaining tool. And we've already seen evidence of that. I'll give you one. if we bring a European car into the US, we pay a 2.5% tariff. But if the Europeans bring a US car over to Europe, there's a 10% tariff, right? So effectively, Mr. Trump said, well, you know what? We're going to put the same 10% tariff on European imports that we have to pay, and all of a sudden the Europeans back down and say, no, no, no. I'll tell you what, we'll match your 2.5. We'll cut the tariff from 10 to 2.5. Great, problem solved. So there's an example of tariffs being a bargaining tool, not necessarily a means under themselves.
Yeah, I mean, reciprocity just seems like such a, common sense, concept, right? Like, is it crazy to think that we should have the same equal tariffs that our trading partners do? And the fact that we don't just speaks to the fact that, yes, we have been getting ripped off for a very long time. And I think it is hard for people to see that. And I think you had another really good quote the other day, Adam. You made a point that we have about $1 trillion worth of imports. Well, it's a $30 trillion economy.
Net imports.
Yeah. Yes. So that's a $30 trillion economy. So at the end of the day, like, it does have an impact, but come on, like, it's
3% of GDP. And if we're talking about tariffs that are only 10 to 25% of the total dollar amount, well, that's 10 to 25% of 3% of GDP, which means we're talking about an amount that is less than 1% of GDP. And yet it's the only thing that everybody can talk about. I'm not going to say much ado about nothing, but I do think we've blown this thing way out of proportion. And, that's the media just doing what the media does, which is to stir the pot, get everybody talking and focused, because if we're not paying attention to the media, then they're not making money. So they're doing their job. I get it. But that's why I tend to tune out a lot of what I hear in the media.
Yeah, except for Fox
Except
Business
for when
Wednesdays.
I go on it.
Well, in the short term, guys, like, valuation does matter, right? In the long term, it matters as well. So we just had a market that's let's be honest, it got stretched a little bit in valuation. So we're having a correction. It's just historically normal. Market doesn't follow the news. The news follows the market. So it's like they're making this. It's got to be the tariffs that are causing the correction. No, it's a correction. Yeah,
they happen.
People are taking some money, some profits.
And how funny, Bob, that when Scott Bessent, the Treasury Secretary, came out and said, well, corrections are healthy, you would think that he had just called for, I don't know, mass executions or something. What? Corrections are healthy? How can you say that? So irresponsible.
There's a highly educated, man with 50 years experience investing, and he's telling you a common sense explanation of what's happening and why it's okay. And it's like, oh no, it's got to be something. It's a horrible thing to say.
Horrible.
Yeah. Well, Cord, I know you're on CNBC Weekly, and what are a lot of the prognosticators saying on there? Are people getting more bearish? Like, what's your? I know you're the optimistic. I hope you're the optimistic one on those shows. But how's the wind blowing these days?
Yeah, whether this is on the media or you actually look at the data, I mean, people are very pessimistic right now. You see those investor sentiment surveys that came out. There's close to 60% bearish sentiment right now, and 70% was the high, like the peak of the 08-09 recession. So, whether this is investors, whether this is CEOs, whether this is consumers, people are very nervous and very uncertain about what the future is holding. I think probably more so than any data is justifying of it. And that's where a lot of this is just sentiment and uncertainty that's driving what's going on right now, is a fact that, as opposed to any underlying data or things that are changing in the economy, right?
Which, by the way, that's a counter trend, right? When people are bearish and extremely negative at the same time, and I think we're at one of the lowest levels on those AAI sentiment weekly indicators that come out.
Right.
And I think historically, every time they get to this level over the next 12 months, the S&P 500 is up like 13%.
Yes.
So when everyone's bearish, be bullish. You know what? You can quote me on that.
Well, the ironic thing too is, like, to your point with like how loud the news is, I've gotten a lot of calls from clients over the past week where they're saying, well, everything's terrible. We got to make changes. And then I'm saying, well, have you looked at your portfolio? And they say, yes, it really hasn't moved that much. So it's like they're hearing all this stuff, but they're not correlating to what's going on in their reality. And I think most people are like that.
Yeah, that's very interesting. You see what you want to see, or you react based upon your feeling, which is not an intelligent way to operate.
It's a horrible way to invest.
Yeah, feelings are legitimate, but
yeah,
they're oftentimes inappropriate at the boardroom table, whether that boardroom table is for your company or your own kitchen version of a boardroom table where you're running your family finances.
Well, I would say the most dangerous phrase you hear from a client is, "I have a feeling."
Yeah.
I just have a feeling that the economy is going to tank right now. We should just get to cash. That's like always the wrong time to do whatever they want to do. Yeah, because I think, to your point, investing with feelings is like the worst thing you could possibly do.
Yeah, I try to take emotion out of it. My whole thing is cash flow growth. I am trying to find companies where, because they have a superior product, a wonderful management team, barriers to entry, game-changing technology, et cetera, where there's a pathway to significant cash flow growth. And if I can model that cash flow growth out 2, 3, maybe 4 years, and then I can distill that cash flow growth into actual profits, and I can put a forward multiple on those future profits, and then calculate a price target that is 2, 3, 4 times above where the stock is trading now, that's something I'm probably going to buy. And that's why I'm willing to own through the vicissitudes, to use a fancy word, the ups and downs of the market from month to month, quarter to quarter, because I'm playing for where I want to be with this company in 3, maybe 4 years.
Well, that's a long-term investor, right?
Yes.
And I think that's the difference between somebody speculating and maybe like Bitcoin. Like, that's why Chris has those shoes, because he just made a killing in Bitcoin over the last couple of years.
The Gucci's?
Yeah, all of a sudden.
Those are sharp.
They are sharp, Chris. Can the camera see
I thought
those?
they were slippers, but
I got them out of Ryan's closet.
Is that my brother or Liberace? But no, I think. But the other thing too is, I think short term is expect the unexpected, and I think that's a good point, Adam. Like, people forget you're buying this as a business based on what that business is going to look like 4 years from now, 5 years from now. Meanwhile, it's priced every day. And Bob uses this line a lot. Imagine if your house was on the market every day and you could see the price of it, right?
Oh, good point.
When most of us, mentally, you buy a house, you're thinking, I'm going to live here for X amount of years. And then I'm assuming in the future, it'll be worth more than it is today. But we don't really take that same viewpoint a lot of times with the stock market because of the price action on a daily basis. And that's what makes it so hard, right, to be a long-term investor. Hey, hope you're enjoying the most recent episode of Payne Points of Wealth. Everything you hear on this podcast, along with some due diligence of your own, can help you get ahead financially, literally at any stage of your journey. But if you want a more hands-on approach and you saved over $1 million, Bob, Chris, and I will put together for you our total financial master plan, and we'll do that with no obligation or cost. It's a full holistic review. We literally look at everything. We go as far as building you your own personalized financial portal. We'll give you a bird's eye view of your entire financial life, and we'll hone in on every financial issue you need to address today. Whether it's an income plan for retirement, how do you take Social Security? How do you draw from your portfolio? How do you factor in inflation? We'll build a dynamic income plan for you. We'll look at diversification. Has your portfolio been up and down with the markets, extremely volatile, or have you been sitting in cash? Paralysis by analysis. You can't figure out what to do. We'll put together a full investment game plan, tie it to your goals, show you how to grow your wealth, but most importantly, protect it over the rest of your life. And we'll look at fees and taxes. Wall Street loves to sell you high cost, tax inefficient products. Whether it's an annuity, mutual fund, brokerage product, we'll do a deep dive of every investment you own. We'll show you how to reduce the cost, optimize your portfolio for taxes. It's not what you make, it's what you take. You'll get our full tax playbook. If you want this full holistic review and you saved over $1 million, simply go to www.paynecm.com/financial plan or click the link below to see if you qualify for a free financial review.
Adam, I've been following you a long time, and you're very disciplined in that you don't buy and hold forever. Like, if you feel a stock's overvalued, you take it off the table. But what do you how do you determine a stock when you give up on a company? What metrics have to change for you to change your mind on that 3 to 4 year hold?
Before I buy a stock, I always set a price target on the upside, and I set an alert on the downside. And if the stock hits my target, I always sell a portion, typically about a third, and then I reevaluate. So great, it hit my target, now what? And if I can justify raising my target, looking further out into the future, I'll raise my target, and that's the new target on the balance that I still own. If not, I'll just sell the whole thing. But chances are I can find a pathway to a higher price because I'm a growth investor. I'm not a value investor. Meanwhile, on the downside, down 35, 40%, typically at that point, I have to take a look at the thing and say, this is really not working. And in the volatility that we've seen over the past couple of years because of the algos. Quite frankly, 30 and 40% declines do happen even for really good companies. So I don't automatically sell down 30 or 40, but there's a point at which I do admit, yeah, this is uncomfortable. So I would say half the time I cut down 35, 40, and half the time I just leave it alone. Every now and then I'll add to something down 30 to 40, but generally speaking, I want the market to tell me I'm right before I add. So I'd rather see it start to come back up a little bit.
What resource do you depend on the most?
Bloomberg.
Bloomberg. Okay.
Yeah, Bloomberg is so good because they have access to so much. I just really appreciate the fact that I'm able to have access that most people, quite frankly, aren't able to have. And I'll give you an example. So I own Delta. And you probably say, Delta? What's American Ingenuity about Delta? It's just an airline. And I would tell you, well, because they segment the cabin 36 ways, because 8 to 10% of revenues are cargo in the belly, so there's no such thing as an empty aircraft. I would tell you 8 to 10% of revenues come from third-party servicing of other aircraft, and they sell the parts, so they repair United airplanes. I would tell you that they make $1 billion just by selling spare capacity to Amex so that Amex can create a rewards program for its Gold Card customers. And I would also tell you that they actually own an oil refinery in Philadelphia as a hedge for jet fuel. So to me, Delta Airlines is an ingenious company. And strangely, they guided down a couple of weeks ago, and Ed Bastian, the CEO, and I thought, oh no, what happened? Well, the only reason I was able to figure out what happened is that Bloomberg had the text of a speech he gave at the JP Morgan Industrials Conference the very next morning. So at 8:30 in the morning, he spoke. By 9:05, I had the transcript in my hand. No one else had access to that who didn't have a Bloomberg or who hadn't been in the room listening. And I realized exactly why he guided down. And it was just weather outages and then a week or two of soft bookings after the two tragic incidents, the
Right.
American Airlines crash in
Sure.
Washington, and then the Delta crash in Toronto, where thankfully no one was hurt. It's a short-term phenomenon, and that's why he left full year guidance alone. So you know what I did? I actually reiterated it as a buy on weakness for
Yeah,
my
I saw
Bullseye
that in your-
subscribers. And the only reason I had the confidence to do that was that I had read the thing that had been the transcript that had been posted on Bloomberg. So that's a long-winded answer to your question, Bob.
Well, also I think it just as a bigger viewpoint, you're also betting on the consumer, right? And I think that is one one variable you and I have agreed on for a long time is, there's always this, like, the employment market's going to fall off a cliff. The consumer's going to run out of money, whether it was, stimulus from the pandemic, whatever it is. And I think that's the one remarkable trend is just how resilient the American consumer's been. And I think you're kind of betting on that because travel has to do with the fact that people have money in their pocket. And I know business travel is a part of that too. And that's probably not going away. But I think just having that macro viewpoint, in my opinion, is really important, right? Because you have to have some belief in where the economy is going. And for you and I, it's been very optimistic. But I think that's also, I'm assuming that's part of your calculation as well.
Yes, I'm a bottoms-up stock picker, but you have to have a top-down view of the market and the economy because that affects everything else, including interest rates. You got to have a view on interest rates.
Where do you think they're going?
I think they're going lower, but not as low as the market would like. They don't need to go lower. In the words of Jerome Powell, the economy is doing just fine, so we can be patient.
Well, I guess my only concern there, I think the wild card is China. And it does look like China's starting to recover. I mean, especially the stock market, I think is a leading indicator. And I guess my only question there is, I know you have a viewpoint, and I like your viewpoint on oil. There's still a war premium on the price of oil. But my question is, if China starts to recover and they're the largest importer of oil in the world, does that change the dynamics in terms of where oil prices go? Because, I mean, really, they've been in a deep slowdown, and that's been a big impact on oil prices also.
Yes, they will soak up more supply. They will demand more. But the fact is, the world is awash in oil. There is plenty of oil out there. And I think if we see peace in Ukraine, we're going to see even more because that Russian oil is no longer embargoed. Libyan oil is back on the market. Venezuelan oil is back on the market. Iranian oil is really the only oil that's in theory not supposed to be on the market, but shh, I got a secret. It's going to the market. So there's a lot of oil out there.
But isn't Russian oil already getting to the market anyway?
Yeah, exactly.
Okay.
Yeah. They have the capacity to produce more. The U.S. is producing more than we ever have. We can produce more and probably will produce more. The Saudis are holding back. They could certainly add to their production. And as you point out, yes, the Russians are capable of producing more, but they have been limited by exports because uh, only the so-called shadow fleet can transport their oil. Flagged carriers from other countries cannot.
Right. So they're still limited in what
They
they can
have the
actually
capacity
export.
to
Yeah.
get more out once more oil tankers are able to actually show up at their ports and receive the oil. But because of sanctions, that's not happening at the moment. So there is capacity to get more oil out. And this is another really important point. I think the whole reason that Trump wants peace in Ukraine is to lower the price of oil, which by definition will lower inflation, and then job accomplished. And he is suddenly looking good here at home. That's the whole reason. And if you notice, the negotiations for Ukraine happened or are happening and will continue to happen in Saudi Arabia. Why? Well, because the U.S., Russia, and Saudi Arabia are the three largest oil producers in the world. There's a new petro order that is taking shape. And I think the Ukraine war is the catalyst for that new petro order. It's those three countries, U.S., Russia, Saudi Arabia.
No, that's a good point because, I mean, oil prices really drive inflation more than anything else. And I think if you look at the 10-year Treasury, almost like lockstep with what oil prices have been doing over the last couple of years. So I think that is the metric to look at. So that's a great point.
Yeah, that's the single unifying factor throughout the world at the moment. These things can change, but oil and bringing oil down, which brings inflation down, which accomplishes a multitude of tasks.
And Trump likes to win.
Trump likes to win.
Speaking of which, do you own any oil stocks?
No, I don't. So here's the thing about oil. If you are an oil company, you are a price taker. That means you have to just take the price that you're given by the market. The price of oil is determined by the market. I would much rather own companies that are price makers. Nvidia makes chips, and it decides the price at which it sells those chips because everybody wants them. They have pricing power. So would you rather be long a company that just has to take the price that it gets from the market, or that's able to set the price, its terms, and then tell the market? I'd rather own the price maker. They make more money. Their profit margins are higher. So that's why I don't own any. If oil gets cheap enough, I'll probably buy Energy Transfer, ticker ET, because the dividend is so high and because they're a toll collector. They're ingenious in their own way. They control about a third of the pipeline networks in the U.S.
We own pipeline energy. Our
and it's
it's
good cash flow. But in EOG, whenever it goes under 100, they're the top producer. They have the best technology, the best real estate, the best balance sheet. So EOG, you buy under 100, you sell it at 150. That's not really my kind of position, but I'll do it at the margin just to have a hand in it.
Well, I guess the other question though is, and I think these numbers, they seem to get skewed. I don't know if it's politicized, but if you look at oil demand and the way it's going up over the course of the next decade versus our ability to produce, it still seems like it is out of whack, meaning that there's going to be more demand for oil than we can basically supply. I mean, that's the stats I've seen on it, but then again, it depends on what stats you're looking at.
Well, yes, and that's why you always have to have an E&P budget, exploration and production. If you're not constantly looking for new sources of oil, yeah, you're right. You do run out. Eventually, the wells run dry, but there's plenty of oil. And what really changed everything was nat gas. And, it's just, think about what nat gas can accomplish. It's not just heating your home, but you can now run nat gas through turbines, really through jet engines. Just look at GE Vernova, right? Ticker GEV.
Well.
Yeah. They basically take what used to be a jet engine, and instead of running jet fuel through it, they run nat gas through it. And they use that thrust to turn a turbine that produces electricity. So you can produce electricity on site from natural gas. So nat gas accomplishes a lot more than just heating a home. It's an electricity solution.
Yeah, and we got a lot of it. Big supply.
We got a lot of it.
Yeah. Well, I think the big question is, though, with this big sell-off, I'm going to Courtney first here because she's the real pro over here. Do you think that we're at the bottom here? Do you think this is the bottom of the sell-off and market's going to recover from here?
I don't know if we're at a bottom, and I think all of us are smart enough to not call the day of a bottom. I know we know that's not going to happen. But I would venture to say we're probably closer to the bottom than not. And I don't know if the bounce that we saw on Friday was that, but you are definitely starting to see some opportunities where investors are willing to come buy in these dips, which is great. And I think when it comes to these kind of sentiment levels, I said this earlier, but it's absolutely a buying opportunity. So is it the perfect bottom? I don't know, but is it still a buying opportunity? Absolutely. And I think that's something you can't pick the exact timing. You still want to buy.
Oh no, I want the perfect bottom. I don't want this, close to the bottom stuff.
Yeah, Ryan's tired of throwing darts at a board.
That's right. No, I think it's a good point. And I think, the other thing that blows my mind is, we talk about this, or we write these stats out every week, but we're over $7 trillion now in money market funds. And coupled with that, there's like another $2 trillion in just like short-term CDs. So the amount of liquidity out there just blows my mind.
Sitting on the sidelines, in other words, that could come in.
Yeah. And I think that's the biggest risk here. And we've talked, you and I talked about this a lot, Adam, but I think the biggest risk here is we could have a huge melt up. And I don't think investors are clear in that position for that. So I think one thing goes right. Maybe it's peace in Eastern Europe, maybe oil prices come down, inflation comes down dramatically. I don't know what the catalyst is going to be. We know what the tariffs are going to be. And we negotiate with everybody and everybody's happy. But, I think you just need one or two things to go right. And really you're sitting on kind of a powder keg right now. So I would argue your biggest risk right now is not markets melting down, but melting up.
Yeah, I would agree with that. At one point within the past week or two, Nvidia was cheaper than the S&P 500. Isn't that crazy?
Yeah.
That's how much stocks have been sold off.
The only time I agree with Adam that Nvidia was cheap.
Yeah.
Meanwhile, it's gone straight up over the years, and I've been wrong. But
yeah, it got down to about 102, 103. At which point it was trading around 20 times earnings, and the S&P 500 at that moment was trading at 20 and a half times earnings. And I thought, wow, Nvidia, the golden goose of AI, cheaper than the S&P 500 with 6, 7, 8 times the growth. If that's not a signal to just start buying some very high quality tech stocks that have just been absolutely trashed by the algos, I don't know what is. So yes, I've been buying.
I think that's the question, though, is there's been this big change in leadership this year where it's not just the Magnificent Seven that's leading the markets. And those are now starting to get a lot cheaper after they've been sold off. So the question is, should you go into your big tech stocks, or do you think this broadening out that you're seeing, is that going to be sustainable if markets do in fact recover?
Yeah, I think so. By the way, Google is also cheaper than the S&P 500. It trades at 19 times. That's crazy, Google. I mean, for crying out loud.
Yeah.
You look at Super Microcomputer, which has been in the news, and they've been exonerated from those false allegations about accounting irregularities. Well, still trading at about 12 times earnings with, according to the CEO, 70% growth this year and next. So again, there's a point at which growth stocks become value stocks during sell-offs, and I think that's where we are. And I'm very comfortable owning a lot of these names because I do think we're going to see a turn, and the turn will happen very quickly because turns always do.
Well, as Bob likes to say, markets don't settle down, they settle up. But I also think there's just a natural bid, under these stocks, just because when money comes pouring in the market, and I just see these retail investors, when they blindly buy, what are they buying? They're buying the S&P 500, whether it's through VU, IVV, whatever. So your Magnificent Seven disproportionately just gets more capital, into those stocks. And I think that also plays into it. I almost think it's going to be like an everything rally at this point. I mean, because who would have guessed this year? I mean, if you told me at the beginning of the year with protectionism and tariffs that Germany was going to be like only the best stock market in the world, and China,
Right.
you just can't, you can't predict these things. But I do think, the bottom line is with all that cash out there, it's probably going to bid everything up, right? If we do get a big rally here. What do you think, Bob?
The market will bottom eventually, and it won't bottom until we have to do another conference call with our clients. Adam, we have a track record which is impeccable. I'm actually going to start a fund based on this. When all of our advisors call Ryan and I and say that people are so worried, they're so scared, you have to talk to them. We put together a fireside chat. Now, we've done this. Last one we did was 2022, October 2022,
Literally right at the bottom.
This latest rally. Yeah. You go back to every, inflection point in the market's, ups and downs. Our clients reflect, the anxiety and the fear. So we're not quite there yet. We're not getting anybody panicking, which is making me a little worried. But I think with the Nasdaq, where you have a lot of stocks, obviously that's where the growth has been. It seemed to have peaked since that DeepSeek announcement came out. Do you see the Chinese as being a big threat, to the AI rally in the U.S. and the Mag 7?
The short answer, Bob, is no. And I'll tell you why. DeepSeek, this theoretical, well, not theoretical, it's an actual competitor to ChatGPT, was supposedly built by the Chinese in a matter of months, if not weeks, for a total cost of $6 million. That's the official line coming out of China.
Right.
Well, dig a little
And
deeper.
China they never lie about their numbers. We know
No,
that.
the Chinese
You can
never
trust them
lie.
implicitly.
They never do. You dig a little deeper, and what you find is that DeepSeek was actually created using 2,000 Nvidia processors. Where's that come from? The U.S. And as it turns out, due to some reverse engineering by some very clever engineers, that some 30 to 40% of the code was lifted directly from ChatGPT. The engineers went back and reverse engineered it because they said some of these conclusions look an awful lot like what ChatGPT would come up with. And so there's the other component. So not only is the hardware chips from Nvidia, but the software programming from ChatGPT, which is owned by OpenAI, which is owned by Microsoft, another American company. So once again, the Chinese are just pirating U.S. technology and U.S. capability.
I guess the only thing is now the technology's out there. If they stole it or didn't steal it, fine. But now that it is out there, it is being able to be done cheaper. And maybe short term it's not a problem, but longer term, doesn't that speak to?
Okay, well, let's talk about Android technology in phones developed by Google. It's an open technology. Well, just because the Android technology is in theory open and available to anyone doesn't mean that Android phones are free. Quite the contrary. They cost the same price as iPhones.
But I'll give you an example now. An app like Apple's a great example of this, right? The Huawei phone and other phones in China, which have stolen our technology, clearly. They're eating into Apple's margins now, right, in a big way. I mean, Apple's biggest problem is they're slowing growth in China. So at some point, maybe not today, maybe that does become a problem.
Yeah, Apple needs to make India look like China. If Apple could develop its Indian business the way they developed the Chinese business, they would practically double earnings.
Well, the other problem is I got my new iPhone.
Oh, yeah.
And it's not any better than my last iPhone.
I know.
So I think Ingenuity is a problem for Apple as well.
I'm waiting for the Air, which comes out next fall.
Air
it's
is going to be
light.
invisible. You can't
it's
see it.
Super light.
But I mean, the technological capability has definitely peaked on these phones for sure. Maybe my camera's a little nicer, but besides that, I think that is a problem. But it also speaks to the Chinese. I mean, the same thing with BYD, right? Their version of Tesla. All of a sudden, their cars look exactly like Tesla's.
Yeah.
And now they claim they have a charging station within 5 minutes. You can charge your car. You can go for 250 miles or something like that. It's pretty wild. So I would wonder, though, if this copycat technology is a problem because it does get to the market and does compete with the U.S.
But again, I'll go back to what I was effectively getting at. Now I'll say it more succinctly. Use cases. So yes, the technology may start to be more open and available to others. A ChatGPT is an example. Versus a DeepSeek, but how you apply that technology becomes proprietary to you. So, for example, Costco uses AI to track people inside the stores. They can tell where you are within the aisle and what you're looking at.
Yeah,
and if you spend time in front of one particular shelf but don't put something in your cart, they know it, and they will actually figure out what that item most likely was based upon your shopping patterns, and they will offer a 10-minute discount if you go back to the shelf and buy that item. That's incredible. Now, there's a use case that is involving AI, and it's proprietary to Costco. Nobody else can steal that, and Costco is using that technology to improve its sales. Well, imagine that across any number of businesses, whether it's Delta Airlines selling tickets, or I mean, you could come up with the examples anywhere.
Well, I think it goes back to what you said earlier, and I think this is our big thesis: is every company is going to be an AI company. It's going to. I mean, this is one of your notes. I mean, like the margins on the S&P continue to improve. We're up to like 13% margins. That's because of productivity gains, and that's just going to continue for every company, whether it's a quote unquote AI company or just a regular company using the technology. And I think that's the big opportunity over the next decade, is just how everyone gets more efficient using automation, robotics, and artificial intelligence. It's incredible.
Well, 10 years ago, every company had to figure out how to become an e-commerce company. Then 5 years ago, every company had to figure out how to become a cloud company.
I just figured out how to use my email,
Yeah,
so I'm getting there.
Yeah, well, you're on that curve, and now every company's having to figure out how to be an AI company.
How are you employing AI into your business, into your practice? How's you've been able to leverage AI so far?
So the irony is that as much of a proponent of AI as I am, and as an investor in AI, given all the stocks I own, I don't really use it in my business. I'm an old school guy. I like running cash flow, and I like looking at companies and reading. So it's ironic that I'm almost an evangelist for AI, and I'll be honest, I really don't use it. I really don't use it in the way that many do. If I'm going to write a letter or write my bullseye every week, I don't run it through Chat GPT. In fact, every time I go to Twitter to post something, it says rewrite with AI ? And I always say no.
Is it because it's just something you don't value, doesn't work for you, or is it just something that you haven't tried?
Oh, clearly my ego is too big, 'cause I think
You said it, Adam.
I think I'm smarter than AI. Yeah, I don't know. We're working on that. We'll get back to you on that.
We're trying to use AI a lot more in our practice, but I kind of agree with you. I try to run stuff through AI, and I find that it will really just not quite work yet the way that I'm hoping it to. Like, I'll write something and I'll say, okay, can you summarize this? And it just takes out really important chunks of information. Like, it just can't quite figure it out yet. And I want to use it, but I don't think it's there yet. But I think down the line, I agree with you. I'm a huge proponent. It's going to make things a lot more efficient. I think we're just still in the really early innings of AI. And when we're going to look back on what it's doing now, we're going to kind of laugh. But I think this just has a ways to go, is really where I see things going.
You're behind the curve. Bob and I are way ahead of you. Bob and I use it all the time.
Really?
Oh my gosh. I think I write everything with AI
for example, we do a lot of our meetings on Zoom, because I don't want my clients to have to fly to Naples to see me. So I go on Zoom to see them. But you can now hit an AI button where it takes notes of your entire call, which is a lifesaver in terms of, putting the notes and making sure you remember everything in this, because we have to contemporaneously keep notes on every conversation with every client as a fiduciary. So that's been a big help. But one of my advisors this morning called me and said she's at a conference in Miami right now, and they have an AI tool that will summarize everything that happened in the portfolio over the last quarter. Deposits in, out, dividends received, what was bought and sold, just at the push of a button. I mean, you can do that. It just saves man hours, or people hours. It's just I think that's where we can see the leverage in our practice.
Okay, well, imagine if we could do this, and maybe, Courtney, this is what you're getting at, because we're not there yet. But imagine if, fine, we could hit dictation and AI would basically convert all of our words during this podcast into, pieces of paper that show written text. Okay, fine. That's not hard to do. But then imagine if it could reorganize it into a sort of bullet point format. So every time we were talking about AI, it might have been at minute 2, it might have been at minute 13, and it might have been at minute 19. And then it could take those snippets and somehow organize that into a cohesive comment or outline format about AI. And then every time we talked about value versus growth, it would do the same. And we wouldn't have to tell it to figure out those different topics or headings. It would just somehow know how to do it the way we all recognize, oh, now we're talking about AI, now we're talking about growth, now we're talking about valuation, right? I mean, that'd be really cool.
I think you can probably do that now. Yeah, that's actually, it's crazy. Well, you can do it. It's unbelievable what you can do right now.
Like I'll write an email to a client And then I'll have AI say, okay, now turn this into a client note for our contact management system, focus on these things. And it'll go into my email and sort out each of those things and put it into and organize it in that way.
In a bullet point format.
In a bullet point format, or however you wanted to do it.
That's pretty awesome.
Yeah, you can tell it numbered. Yeah.
Another thing you might want to do, Adam, I do this all the time. If I get an article that I think looks interesting, but it's really long, and I'll just copy and paste it into AI and ask it to summarize it in bullet points. And then I'll say, oh, this looks like something I really want to read. That saves me a lot of hours of reading useless information. So that's something that you might find helpful.
Oh, yeah. Well, we'll give that a whirl.
We know what Adam's going to do the rest of this afternoon. Bob, I think you and I are here to inspire. That's all we do. Everyone should do the work, and we just, we make it look pretty. Yeah, and I think, if you look at the demand, and to your point where the multiple is right now, and you couple that with just the amount of cash on the sidelines that is going to go blindly into places like the S&P 500. I mean, that should have a real bid under that stock. Because that's probably the cheapest that stock's been.
Nvidia? Oh,
and
gosh.
you and I have been talking about it on TV. Yeah,
For
when I would
sure.
say, oh, no, I think it's overvalued, Adam, and then it would go up again. And then next week would be on, I think it's overvalued, Adam, and I'd be, no, it's not, and it would go up again. So,
Well, earnings went up
Yeah.
tenfold, which is why the stock went up tenfold. Yeah, I mean, it was amazing. And yeah, now it's cheap. I mean, now it's amazing to me that it actually trades similarly to the S&P 500. But the S&P 500 is growing 12%, and Nvidia is growing somewhere between 50 and 75% for the same price. It's amazing.
All right, it's the hidden facts of finance, random financial facts that may surprise you or even shock you. All right, Bob, the U.S. has suffered 14 official recessions since the Great Depression. In other words, the U.S. economy contracts only 15% of the time, yet those strategists, they're always calling for a recession, Bob.
I wish I could find it. I used to have a chart that would show, the market, ups and downs for over 100 years. And at every peak, and across that chart, they would lay over the 15 or so recessions, like you said, that occurred. But at every peak, there'd be a note, this is the top, right? So every strategist has been calling a top for 100 years, and they've never been right because these recessions don't last, and they're very infrequent.
Yeah, I've got another one to add for that, Bob. So Bloomberg tracks the sort of consensus among about 30 economists. Do you think there'll be a recession? And if so, what are the odds? Well, they ran a headline in a story last week, and they said the recession expectation indicator ticks up to 25% from 20%. So I look back at the chart. Well, the 30-year average is 29%. So 29% of the economists always think there's going to be a recession. And now at 25, the new headline, it's still below the average. So yeah, I take all that with a grain of salt.
Well, I remember the strategist for Goldman over the last, I followed her for like 30 years. And, during the big boom and bull market in the 90s, she went from a 60-40 allocation. And then in 2/3 of the way through the bull market, she moved it to 65-35. That was the only thing she changed in 30 years.
All right, Chris, solar power in the U.S. is experiencing rapid growth. In 2024, the U.S. solar industry installed nearly 50 gigawatts of capacity, marking a 21% increase from 2023. Solar power accounted for 66% of all new electric generating capacity added to the U.S. grid in 2024. Well, maybe these alternative energies aren't going away. I don't know.
Those solar panels wear out after a couple of years. You can't really dispose of them. I don't know. I think it might just be a fad.
Well, I feel like I know the hype's about oil right now, but I do think these alternative energies actually are going to continue to grow in the U.S., even though it's not like in favor right now.
To an extent. But I will tell you, I've lost money on every single clean energy stock I've ever bought. They've been a total disaster. From ChargePoint, which was supposed to create this whole network of chargers around the country, to Sonova, which was installing panels. It was the most profitable solar installer. And then we realized that the only reason they were profitable is government subsidies and low interest rates that were, so low, it was practically zero, right? So money was free. And you take away free money and government subsidies, and a lot of these clean energy companies just can't stand on their own. So I won't touch them. I'm over clean energy.
Well, it's a good point. You have higher rates now, and we know those subsidies are going away. It's the one thing we do know in this new administration, for sure.
You know, Ryan, Adam made a good point. I think we should get some government subsidies to make Payne Capital finally profitable.
You guys do just fine.
We're gonna install some some wind turbines on the roof here. Get some benefits.
Rent out your office to the federal government.
Be too much efficiency for the government. We got to slow things down a little bit. Right. I don't know. Bob's got more of a bureaucratic style nowadays. When he starts around noon, leaves around 3.
I don't know. I got an email from Dad the other day that said, "What have you done this last week?"
Yeah, give me 5 things.
Yeah, 5 things. Let's see, Dad. You golfed 5 times, right? That was.
All right, Adam. In 2015, the global number of adults living with obesity was estimated to be around 604 million, compared to the projected 1.13 billion in 2025. We can see that number of obese adults has nearly doubled over the past decade. And in 2025, it's projected that we'll have about 100 million adults just here in the US with an obesity problem. Should we just buy GLP-1 drugs?
Well, my fiance would tell you yes, because she works for Novo Nordisk. But yeah, exactly. Baseball been very, very good to me. Right? That's an old school illusion for our Saturday Night Live friends from the 70s, right? Remember Garrett Morris? Baseball been very, very good to you.
No, classic.
Yeah. Novo Nordisk been very, very good to me. Keep eating, people. So it's shocking to me because I'm a former high school wrestler and I had to lose 25 pounds every year, and I did that by just not eating
and spitting into a cup, probably.
Yeah. Oh yeah, we did that right before the match. It's amazing. If you don't eat, you lose weight. What a concept. But somehow we want to keep eating in the same way that, well, we want to have low cholesterol, but we still want to eat the bacon, egg, and cheese. Oh, no problem. Just pop a pill and that'll take care of it. It'll lower your cholesterol and you can still eat the bacon, egg, and cheese. And I guess my problem with this whole GLP thing is we're putting so much garbage into our bodies, and now we're putting chemicals into our bodies to fix the garbage. Well, why don't we just stop eating garbage?
Yeah, it's crazy. And then the good news on top of that, you don't have to exercise anymore, right? So
yeah, right.
Yeah, which who knows? That can't be good for your brain to exercise. I mean, it's crazy. I think it sends the wrong message.
Yes.
And it's just like the proliferation right now is insane.
It's an abrogation of responsibility. We all have responsibility to ourselves and to one another. And part of that is leading a clean life, being honest, working hard, etc. To take these shortcuts, just to me, is not what has always made this country great.
Hey, hope you enjoyed episode 197, The Pain Points of Wealth. If you like our podcast, you love our podcast, give us that 5-star rating on iTunes, Spotify. You can subscribe to our channel. If this is on YouTube right now, you can click that little notification bell. You update every week of all our new content. Subscribe, like this episode. All your support gives us the support to continue to do this podcast. That's it for this week. As always, stay loose and keep an open mind.
Thanks for listening to The Pain Points of Wealth. Hopefully, you found the ideas discussed in this episode valuable and useful for your own financial journey. You can find out more about Bob, Ryan, and Chris's firm, Payne Capital Management, at bebullish.com or through the contact information found in the description of this episode in your podcast player or app. Join us next week for another episode of The Pain Points of Wealth, brought to you by Payne Capital Management. Information provided on today's show is provided for informational purposes only and does not constitute investment, tax, or legal advice. Investment is obtained from sources that are deemed to be reliable, but their accuracy and completeness cannot be guaranteed.